One company just spent itself into a massive hole, and it dragged the entire AI stock market down with it. This is the first major crack in the AI bubble, and it reveals a risk that almost no one is talking about. Last week, a darling of the AI boom did something that sent a shockwave through the entire market. They revealed a staggering amount of spending tied to their AI ambitions, and in a matter of hours, tens of billions of dollars were wiped from the value of AI stocks across the board. This wasn't just a bad day for one company. This was the first visible crack in the great AI bubble, and it exposed a huge risk for anyone invested in this space that we need to talk about right now. If you're invested in the US stock market, or if you have any exposure to these AI stocks, then you might want to listen up. The company at the center of this storm is Oracle. On Wednesday, after the market closed, Oracle released its quarterly earnings report, and on the surface, things look pretty good. Their adjusted earnings per share beat Wall Street estimates. They announced their backlog of future contracts, what's called remaining performance obligations, or RPO, had soared to an incredible $523 billion, thanks to huge new deals with AI leaders like OpenAI, Meta, and Nvidia. This is the kind of number that signals immense demand for their cloud infrastructure services. But then came the bombshells. First, despite the huge backlog, their actual revenue for the quarter slightly missed expectations. And second, the company announced a massive increase in its spending plans. They revealed they would be ramping up capital expenditures to roughly $50 billion for the next fiscal year, a jump of about $15 billion from what analysts were previously expecting, with the money earmarked almost entirely for building out new data centers to handle the AI boom. And that's where the story turned. Investors looked at the slight revenue miss, saw the mountain of future spending, and connected it to the company's already significant debt load. As of its latest reports, Oracle's total debt is hovering around $100 billion. This spending plan signaled that the debt was only going to grow. The reaction was immediate and brutal. In overnight and pre-market trading, Oracle stock plunged by over 11%, wiping out billions in market value. But it didn't stop there. The fear was contagious. Shares of Nvidia, the undisputed king of AI chips, dropped. So did AMD and other tech stocks. The damage spread to the hyperscalers, with Microsoft and Google all seeing their stocks dip. One company's balance sheet anxiety had just sent a shudder through the entire AI ecosystem. The question is, why? What happened with Oracle wasn't just about Oracle. It was a symptom of a much larger, more fragile dynamic that has been building under the surface of the AI boom for the last 2 years. The ground beneath the AI market is shifting, and this event exposed 3 critical vulnerabilities. First, it revealed just how dangerously interconnected this market is. The AI industry isn't a collection of independent companies. It's a tightly woven web. One company's spending is another company's revenue. When Oracle said it was spending billions on data centers, that was supposed to be good news for chip makers like Nvidia. But the market reacted differently. It saw the debt Oracle was taking on and got scared. The fear wasn't just about Oracle's ability to pay its bills. It was a fear that the entire cycle of spending was unsustainable. If a major cloud player like Oracle is taking on this much risk, what does that say about the health of the whole system? This brings us to the second vulnerability, the risk of a debt-fueled circular economy. For months, analysts have been pointing to a strange loop happening in AI. A tech giant like Microsoft invests billions in an AI company like OpenAI. OpenAI, needing massive computing power, then turns around and signs enormous multi-billion-dollar cloud contracts with providers like Oracle and others. In fact, OpenAI is diversifying its cloud partners precisely because its need for computing power is so severe. Oracle then uses that future revenue to justify taking on more debt to buy more chips from Nvidia to build the data centers that OpenAI needs. It's a snake eating its own tail. While many of the biggest tech players are funding this expansion from their own massive cash flows, the increasing reliance on debt by some major players introduces a new layer of risk. What happens if the return on these AI investments doesn't come as quickly as hoped? What if the revenue from these giant contracts is delayed? The debt remains. The interest payments are still due. Oracle's stock drop was the market suddenly waking up to the fact that a significant portion of the AI build-out is being financed with borrowed money, and that makes the entire structure incredibly fragile. The third vulnerability is the one that brings it all home. Sky-high valuations that are completely disconnected from reality. This market has been powered by narrative, not fundamentals. The Magnificent Seven tech stocks have at times accounted for over a third of the entire S&P 500's value. That's a level of concentration that is historically extreme. For most of recent years, AI-related companies have been responsible for a huge portion of the stock market's gains. This is where the parallels to the dot-com bubble of 2000 become impossible to ignore. Now, it's not a perfect comparison. Many of today's AI giants are wildly profitable, unlike the ideas on a napkin companies of 1999. However, the warnings are getting louder. Both the International Monetary Fund and the Bank of England have recently issued warnings about a potential sharp market correction, driven specifically by stretched valuations in the AI sector. The IMF's managing director, Kristalina Georgieva, has drawn comparisons to the dot-com bubble and advised investors to buckle up, stating that uncertainty is the new normal. They see a market where investors have priced in all of the potential upside of AI with none of the risk. Oracle's plunge was the first time a major downside risk, the risk of a debt-fueled spending binge gone wrong, became terrifyingly real. Now, if you're getting value from this analysis and want to stay ahead of the big shifts in the market, make sure to subscribe to the channel. We're tracking these developments every week, and our goal is to give you the clear-eyed analysis you need to navigate this volatile environment. So the first crack has appeared. What does this mean for you, the investor? This isn't a signal to panic sell everything, but it is a massive wake-up call. It's a signal to shift your thinking from chasing the hype to analyzing the underlying structure of your investments. Here are 3 key takeaways for how to navigate this new reality. First, you have to start looking at the balance sheets. For the last 2 years, the only thing that mattered was a company's connection to AI. Now the market is starting to care about old school fundamentals again. How much debt does a company have? What is its cash flow? A company might have billions in future AI contracts, but if it's drowning in debt to fulfill them, it's a risky bet. The Oracle situation proves that a massive backlog of orders doesn't make you immune to a market panic if your finances look shaky. Don't just ask if a company is an AI company. Ask if it's a profitable company with a sustainable business model. Second, think in terms of second-order effects. The easy first-order thinking was, AI is the future, so buy AI stocks. The more critical second-order thinking is, how is this AI future being built? Who is paying for it? Who is dependent on whom? The market revealed its fear of the interconnected, debt-fueled spending loop. Understanding these deeper connections is now essential. This means diversifying not just across different companies, but across different parts of the value chain that might not be so tightly correlated. It's about reducing your exposure to a single point of failure. Third, and most importantly, distinguish between the technology and the stock market bubble. Artificial intelligence as a technology is real. It is transformative and is projected to create trillions of dollars in economic value over the next decade. But that does not mean every company with AI in its pitch deck will be a winner. The dot-com bubble is the perfect lesson here. The internet was truly revolutionary, but that didn't stop companies like Pets.com from going bankrupt and wiping out investors. The winners of the internet age, like Amazon and Google, were the ones that eventually built robust, profitable businesses. The same will be true for AI. The challenge for investors is to look past the speculative frenzy and identify the companies that are actually integrating AI to generate real, sustainable economic value. The fallout from Oracle's earnings report wasn't just a one-day news story. It was a paradigm shift. It marked the moment the market's giddy optimism about AI was forced to confront the cold, hard reality of debt and execution risk. The narrative has changed. The idea that AI spending was an unquestionable good, a virtuous cycle of investment and growth, has been shattered. Now, a new risk factor has been proven. The risk of a contagion of fear spreading through a financially over-leveraged and dangerously interconnected ecosystem. This doesn't mean the AI boom is over. Far from it. As some analysts argue, we may only be in the early stages, but the ground rules for investing in it have changed overnight. The age of blind exuberance is over, and the age of critical analysis has begun. The companies that will thrive in the next phase are not necessarily the ones making the biggest promises, but the ones with the strongest foundations. Now I want to turn it over to you. Now that this vulnerability of debt-fueled spending has been exposed, what other hidden risks do you think are lurking in the AI market? Let me know your thoughts in the comments below.